Hello everyone and welcome to our monthly fixed income update. It's been an eventful period for markets, so let's dive straight into key developments that shape the markets. Over this time, we witnessed three major events that influence market direction. The announcement related to India-US trade deal, second the UN budget, and thirdly the Monetary Policy Committee meeting. Before these events unfolded, the market was grappling with a series of concerns: steep US tariffs, heightened geopolitical concerns, and persistent FPI outflows. This combination triggered a sharp depreciation in INR, which briefly touched an all-time high against US dollar. Despite the supportive domestic backdrop of strong growth and moderate inflation, however, the sentiment improved meaningfully following the India-US trade announcements, leading to a swift recovery in the INR. Moving to the budget, the market entered the event expecting lower borrowing numbers and greater clarity on fiscal consolidation trajectory. While the fiscal consolidation path remains intact, the announcement of higher borrowing number worried the market. This pushed the G-Sec yields upward, especially at a time when the markets were already dealing with demand-supply imbalances. Then came the MPC meeting, where the committee kept the repo rate unchanged at 5.25%, maintaining a neutral stance in line with the expectations. The RBI revised its FY26 GDP growth forecast upwards to 7.4%, along with a 20 bps upward revision to the growth expectation of first half of FY27, reflecting continued strength in economy. On inflation, the RBI guided for a slightly firmer trajectory, raising its FY26 estimate to 2.1% from 2%, alongside higher expectation from the first half of FY27 as well. This upward revision is consistent with an economy emerging from a very low inflation phase and now experiencing a cyclical growth recovery, supported by fiscal momentum, monetary accommodation, and easing macroprudential norms. Looking ahead, liquidity conditions are poised to improve as FX intervention moderates. Reduced intervention will mean lower Rupee absorption, which in turn lessens the need of OMOs. Recent measures have already helped to normalize money market conditions, with overnight rates dipping below SDF rates. In terms of valuations, the longer tenor G6 are looking quite attractive, with much of the recent volatility already priced in. However, the market is still staring at a large supply next financial year, and in absence of strong near-term catalyst, the yields may remain in a range-bound zone. As we move into the next fiscal year, the market will take cues from RBI, particularly regarding the pace and scale of OMOs, and also watch for any signs of a rate cycle reversal in the medium term. That's all for this month's update. Thank you for joining us, and we look forward to sharing more insights in next edition.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.